So excited to have you tonight. And my name is Lunta Di La Paulo. I'm the founder of Yetu Accounting and Tax PLLC. I'm thrilled, in fact, to be here tonight to be able to share with you some really amazing information. And as I always say, what we share with you is designed to empower you, to equip you, to be able to act, to take action on the information we pass to you so that you can make better business decisions, you can grow your company, you can be more profitable. And every single day, I am challenging myself to give you about 10 minutes of our time to share with you valuable information that is designed to be fundamental for your journey as a business owner. And we launched this series of daily lives where we are addressing in the next couple of weeks the subject of exit planning for a lot of business owners. If you don't know me, if you don't know my background, I used to be an investment banker. I know from the investment banker perspective and the CPA perspective what a good business actually looks like and what businesses seller or buyers, excuse me, are not interested in looking at. Okay, a lot of business brokers, even some investment bankers, are gonna come and tell you we're gonna sell your company or we're gonna get you a deal. But trust me, not every company gets sold. In fact, a lot of statistics, a lot of research, day in, day out, continue to tell us that only one in about 12 company ever gets sold. That's a very small number. And think about it, even among these one out of 20, out of 12 companies, right? About 20%, only 20% of these companies actually manage to get sold under the terms they want, under the price they want, and under the timeline the owner had in mind. So it's not easy today for a business owner to exit under the terms they want. Today, we're going to be talking about day three, that is around common exit strategies that you need to know as a business owner that are available for you. Okay, we're going to talk about four ways, four strategies available for you that you can consider as possible options for exit. Let me tell you what's not included here. IPO, because my target group are small businesses. Most, if not all, small businesses are not designed to exit through an IPO. Okay, so let's just rule that out. That's not one of the ways we're gonna talk here. We're gonna talk about here so that we both know where you stand, where we stand, and what we're gonna be learning today. Okay, so that's great. So I said we're going to be covering four strategies that will be useful to you, that you should be considering as a potential avenue when it comes to exit. But I like to start my lives but by telling people about some of the facts we know. Okay, I like to begin this conversation with both of us. I'm speaking exactly and specifically to you, right? I want to start this conversation with facts. Okay. And here's the facts. You and I know that whether or not we like it, whether or not we want it, it's 100% guaranteed that we're going to exit from our businesses. Yes and yes? Yes. Okay. Because whether we exit by dying or through a sell or a transfer of the business, or because we need to go to retirement, or because we got sick, we're going to need to exit. It's unavoidable. It's, excuse me, inevitable. Yes, it's 100% that we're going to exit. And the question that I always bring to business owners is, what's going to happen when the time for your exit arrives? Are you actually going to be able to exit under the terms you wanted, under the price you were looking to achieve, under the timeline you wanted to achieve? Okay, very important. Exit planning is about closing that gap between what you desire to get and what the market expect to give for a given level of asset. Okay. We explain exit planning, our methodology and philosophy to client the following way. Exit planning is about developing a roadmap that allows business owner to create value in the company, to increase the value so that they can be able to achieve their goals when their time for exiting the company arrives. That's how we think about exit planning. Some people out there may tell you, we can help you exit, prepare for your exit, but they don't really know what exit, business exit is. A lot of people think, hey, my financial advisor is going to help me with exit planning. That's not their job. That's not how their function is designed to operate. Or my business broker or my investment banker, that's not what they do. I'll tell you, as a former investment banker, very often what we're doing as investment banker, right? If we are involved in M&A transactions, we can work on a buy side or sell side. What that really means is on the buy side, we support clients who want to acquire businesses to help them navigate that process, finding a good target, doing the proper due diligence, and negotiating the target and walk them through the close. Okay. On the sell side, it's the opposite of that. We work with business owners. We help them in the stage they are in their business, find a buyer for their business and negotiate the transaction for them for a good deal. What's actually happening here? What's happening is that your business gets sold as it is, as it is. Okay, that's it. The investment banker might try to make it look nicer, may want to create beautiful decks to present to potential buyers, but at the end of the day, when the quality of earnings begins or the in-depth due diligence begins, do you know what happens? People start uncovering the true realities of the company. They start identifying gaps, they start identifying problems, they start identifying flaws. They realize that the cash flow your investment banker put in the deck may not actually be that level of cash flow. The level of profitability you seem to be boasting may not even exist. So the time for preparing for these objections is through the process of exit planning. Okay. I actually tend to think of exit planning more as a management consulting space. Okay. It's more as a management consulting space. Some people are gonna think, Paulo, I don't think so. I disagree. Okay, that's fine. We don't have to agree on everything. But for a lot of business owners, they make the mistake of thinking that their business broker is going to help them get a good deal, their investment banker is going to help them get a good deal. Even the best investment banker is not going to be able to sell a bad company at a great price unless they find an idiot. Okay, those are just facts. Okay, those are just realities of the marketplace. And we know today that business buyers are getting a lot smarter. They're getting a lot wiser. They're getting more sophisticated. They are coming with a team of advisors, of accountants, of lawyers, okay, that an industry expert to really comb the company to find the problem so that they're not going to be the losing party in that transaction. Okay. But what we're also seeing is that a lot of sellers are not prepared, are not represented by the best people in the industry possible. Why? Because some sellers want to be cheap. That's the problem. You can try to save a few bucks and lose millions of dollars because you hired the wrong team. Okay. I actually just went in a big tangent, but I believe it was really important for you to know this, to get this information. But for our conversation today, we are talking about the common exit strategies available to you. Okay, common exit strategies available to you. So I'm gonna talk about these four strategies to help you get a sense of what you can do, where what Possibilities are out there. Probably there are others, but these four are going to be the key. Number one is one way for you to exit is just liquidating everything. Close down, liquidate the assets, get a few bucks, you're gone. You don't have to respond to anybody. Okay? That's probably not the best way to liquidate, to exit from your company, unless the book value of your assets are higher than the market price, okay, or the cash flow that the asset can produce for you as a business owner. Okay, that could be one way for you to exit. So let's just think about this. In this type of situation, we're not really looking a lot at the profit and loss statement. We are rather looking at the balance sheet. We're looking at the strength of the balance sheet. If the balance sheet is made up with low debt and very solid and valuable asset, whether fixed or tangible, you can just sell these and actually make more money. If in the P&L you have a lot of loss, okay, that could actually be an optimal situation or scenario for you to exit. So that's number one. Number two, assuming you have a profitable, cash flow positive business, you can sell your company to what is called insiders. Who are the insiders in your company? We can identify at least three groups of insider. There are more. Okay. The first one is employees. You can sell your company to your employees, assuming they want to acquire the company. Okay. Or you can gift it to them if you want. But most business owners are more interested in selling the company than transferring to employees. Okay. And one way that we know that this happened is through an ESOP. We don't have a lot of time to cover this, but an ESOP is essentially a type of tool. It's a tool that is designed to facilitate the transfer or the sale of a company from its current owner or owners to employees. Okay. This is one approach. The second group of insiders are the management team insiders. If you have, let's say, a company over $2 million in revenue, it's more likely that you have some form of formal management team. Okay. And you can sell your company to them. In the investment banking world, we use the expression of management buyout, where a group of executives decide to come together and acquire the shareholders of the company. Okay, that's approach number two within the group of insiders. Number three, you can also sell your company through your existing partners or shareholders, right? If you are an LLC, then that would be your other members, right? So these are the three groups of insiders that can also acquire your company. But they are more, excuse me. You can also sell your company to either your vendors or your clients, right? Because they are a type of insiders, right? Or other professionals who, part of vendors could be your attorney, your accountant, um, your external consultant, and so forth. But the three groups that often um, go into the process of acquiring your business are going to be employees, management team, or other partners and or shareholders. So that's number two. Okay. So just a reminder here, we talked about the approach of shutting down the company and liquidating everything. You can do that. That's one way to do it. And we also said that you can do that when the book value of the assets is higher than selling the company based on a multiple of cash flow if it's lower. Okay. And the second approach that we just discussed is exiting through a sale or transfer to insiders. And we considered insiders to be as employees, management team, or existing shareholders or partners. Okay. Now, the third group are third party, right? Non-related third party. And these can be in form of strategic buyers, right? Strategic buyers are typically companies in the same industry to you, or around, either in the vertical or horizontal of your industry, right? Your competitors can acquire you, or your vendor, let's say your raw material provider, or in the downstream, they can also acquire you, who are in the middle, right? So those are your strategic. Typically, they tend to pay slightly higher price than the next group, that is financial buyers, right? Strategics are thinking about opportunities for cost saving initiative, synergies. They are looking to acquire a talent pool that they know exists in your company. We often see these in technology business models. Sometimes they also want to acquire a key asset, a valuable intellectual property, right? So they are driven by the synergy they can get there. But it's not only a matter of saving money, but they could also acquire your company because they are interested in penetrating a niche, a customer segment, or a market that it could have been a lot more complicated if they did it on their own, right? So by acquiring your company, they get the advantage of not having to make the mistakes you've made to build the company to the place that is today. So the strategic buyers can be, a good exit strategy for a lot of business owners, because they typically are more excited to pay a little bit more than financial buyers. So who are financial buyers? Financial buyers are the group of business buyers who are more inclined to buy a company for the pure and sole reason of getting a high return on their capital. Okay. These can be folks like private equity groups, independent sponsors, family offices, right? We are seeing a growing number of search funds across the US and in other parts of the world, right? So these folks are looking to acquire the company to generate above market return uh, for themselves and their investors. So this is the third group. And the last group, typically we don't see a lot of sell, but we see a transfer of the company. And this is to the fourth strategy to exit, that is two family member. You transfer the company, the management of the firm, to your children or your spouse, siblings, or other loved one who stay around to manage the day to day of the company. And maybe when you do that, you move to a chair position, and you reduce your involvement with the firm, and you oversee the management team, who are now your siblings, and you're still drawing a decent a decent salary for yourself. So we are almost to on top of our 10 minutes, and these are really the four strategies, the four approach or group of folks that you can consider exiting your business from. But realistically, you know uh, if we can put a summary here, I would say you have about three ways that you can exit, right? You can liquidate, you can sell, or you can transfer. And then these different groups of people, they can either acquire your firm, or you can transfer the business to them. But at the end of the day, it's really important for you as a business owner to understand the motivation of each group, what they're looking what they're looking for in terms of a business they want to acquire. Okay, what interests them, what attracts them, what makes them interested in a company, but more importantly, okay, how prepared they are to actually take your business and move it to the next level. So we're gonna wrap up our conversation here. We are exactly 10 minutes. If you have any question, if you need any help, you can book a call here. You can see a QR code on top. And if you want to send us an email, okay, I'm going to put our email here for you. You can send us an email at hello@7exitmistakes.com. That's our contact information. If you have any question, please feel free to reach out to us. Follow us on our social media as well. You can use our handle on social media here at Yeto Advisory, or if you go in almost every social media and type hashtag Yeto Advisory, it's more likely to be us. If not all the time, it's gonna be us. And if you, before we go, let us give you a gift here. Okay. If you want a copy of our most recent ebook, let me actually put it here on top for you to see. Okay. Where do I go for this? I literally forgot where it was. Okay. So here's a copy of our most recent ebook, Seven Exit Mistakes Business Owners Make. Uh, that cost them a fortune. So go to the website at the bottom here, www.luntadilapauloCPA.com/seven exit mistakes. You'll get a free copy to help you begin your exit planning preparations. Okay. I hope this was helpful to you. Feel free to reach out again if you have any question. We're here to help you. We want to be a help for you and your business and your family. Have a great rest of your day. God bless. And I hope to see you tomorrow in our